Get ready because the news cycle is absolutely blazing, and we're here to bring you the absolute hottest updates you need to know. The pace is relentless, the innovation is nonstop, and if you're not plugged in, you're missing out. Today, we're diving deep into the seismic shifts happening across critical industries, uncovering the stories that are shaping our future right now. From market-shattering records to strategic moves that are redefining the landscape, strap in because this is Qualcomm Pulse, and you're getting the unmissable intel first. First up, we're talking about the undisputed king of chip manufacturing. Get ready for some mind-blowing numbers as one company absolutely smashes revenue records, cementing its dominance with a market share that's simply astronomical. We're breaking down what this means for the tech powering your world. Then, we pivot to a crucial aspect of this industry giant's strategy. How is it balancing historic financial success with massive expansion plans? We'll explore the delicate dance between shareholder value and the relentless pursuit of next-generation technology. Next, a surprising development sends ripples through the market, a significant price adjustment from a major player. What's behind this unexpected move, and what does it signal for the future of high-tech manufacturing? We've got the inside scoop. And finally, we're zooming out to look at the bigger picture of industry dominance. Is one company truly calling all the shots? We'll unpack the staggering market share figures that are raising eyebrows and setting new benchmarks. Stick around, you don't want to miss this. Hit that subscribe button, ring the notification bell, and let's get started. Foundry dominance redefined. The global chip manufacturing landscape just saw a seismic shift, with foundry revenue soaring to an unprecedented $41.7 billion in the second quarter of 2025, marking a staggering 14.6% leap quarter-over-quarter. This surge is largely fueled by insatiable demand for AI accelerators, the latest smartphones, and a new generation of AI-ready PCs. At the epicenter of this boom is Taiwan's semiconductor manufacturing company, TSMC, which has not only ridden this wave, but has effectively become the tide, capturing an astonishing 70.2% of the global market share. TSMC's latest figures reveal a colossal revenue of over $30 billion for the quarter, its most robust performance to date. This level of dominance isn't accidental. It's the result of strategic foresight and relentless innovation. While competitors have faced challenges, TSMC has leveraged its unparalleled process leadership to secure critical contracts for the very chips that power our most advanced technologies. From the A-series chips in Apple's iPhones to the high-performance GPUs from NVIDIA that drive data centers worldwide. The company's advanced node technology, particularly its 7nm process and below, now accounts for nearly three-quarters of its sales, with its cutting-edge 3nm process alone contributing approximately a quarter of its wafer revenue. These are the foundational components powering breakthroughs like NVIDIA's Blackwell GPUs, AMD's Zen 5 CPUs, and Apple's M-series processors for Macs. The timing of this expansion is particularly noteworthy. The smartphone market has shown a strong recovery, and PC manufacturers are proactively stocking up in anticipation of the fall launch of AI-powered laptops. NVIDIA, a key TSMC client, continues to drive demand for high-performance wafers, pushing shipments for both data center and consumer GPUs to record levels. Furthermore, TSMC's advanced packaging capabilities, essential for integrating memory and compute units efficiently, provide a significant competitive advantage that rivals struggle to match at scale. In stark contrast, Samsung, while achieving a respectable 9% growth in its foundry business, remains a distant second with a 7.2% market share. Its successes include chips for smartphones and the upcoming Nintendo Switch 2, but the gap between Samsung and TSMC has widened considerably. Intel's foundry ambitions, despite substantial investment, are still a fraction of the market's scale. China's SMIC experienced a revenue dip of 1.7% compared to the previous quarter, attributed to difficulties in advanced node production and subsequent shipment delays, leading to a 5.1% market share. For consumers, this means more advanced chips are available than ever before, alleviating the severe shortages seen in previous years. However, The downside is that these cutting-edge components are unlikely to become cheaper. TSMC's forthcoming 2nm node is expected to command a premium price, and NVIDIA has already adjusted GPU pricing upwards to offset rising wafer costs. This dynamic of increased supply coupled with higher costs defines the current semiconductor industry. With TSMC commanding 7 out of every $10 in the foundry market, it's clear the company is not just benefiting from the AI boom, but is actively shaping its trajectory. But how does TSMC sustain this incredible momentum? We're about to explore its dividend strategy amidst this record-breaking expansion. Dividend dynamics amidst expansion. As Taiwan's semiconductor manufacturing company, TSMC, continues to shatter revenue records and solidify its near monopoly in the global foundry market, its strategic decisions regarding shareholder returns and reinvestment are under intense scrutiny. The company's recent financial triumphs, driven by the insatiable demand for advanced chips powering AI, smartphones, and next-gen PCs, have put its dividend strategy in the spotlight. Investors and analysts are keen to understand how TSMC plans to balance rewarding its shareholders with the colossal investments required to maintain its technological lead and expand its manufacturing capacity globally. TSMC's commitment to returning capital to shareholders through dividends has been a consistent feature of its financial policy. However, the sheer scale of its capital expenditure plans, including the development of 4nm and future process nodes, alongside the construction of new fabrication plants in Taiwan, the US, and Japan, presents a complex financial juggling act. The company is not only investing billions in R&D and advanced manufacturing equipment, but also in building a robust supply chain and workforce to support these ambitious projects. This aggressive expansion is crucial for meeting the surging demand from major clients like Apple, NVIDIA, AMD, and Qualcomm, all of whom rely on TSMC's cutting-edge technology. The sustainability of TSMC's dividend payout ratio in the face of these massive investments is a key question. While record revenues provide ample cash flow, the company must ensure that its reinvestment in future growth does not compromise its ability to maintain or increase its dividend payments. Analysts are closely monitoring TSMC's cash flow generation, debt levels, and its projected return on investment for its new fabs. The market generally expects TSMC to continue its dividend growth, but the pace might be influenced by the capital intensity of its expansion projects and the competitive landscape. Furthermore, TSMC's dividend strategy is also viewed in the context of its overall corporate governance and its commitment to long-term value creation. A stable and growing dividend can signal financial health and management confidence, which is particularly important in an industry as cyclical and capital-intensive as semiconductors. The company's ability to maintain its dividend amidst such aggressive expansion could also serve as a competitive advantage, attracting and retaining investors who value both growth and income. The market's reaction to TSMC's financial strategies is often swift and significant. Any perceived imbalance between shareholder returns and reinvestment could impact its stock price and valuation. As TSMC pushes the boundaries of semiconductor technology, its dividend policy will remain a critical indicator of its financial strategy and its commitment to all stakeholders. The company's ability to navigate these financial waters successfully will be key to its continued dominance and long-term success. But even with record revenues and strategic expansions, the market sometimes reacts in unexpected ways. We're diving into a surprising price adjustment that's raising eyebrows. Price adjustment intrigue. In a market characterized by soaring demand and record revenues for semiconductor manufacturing giants, an unexpected price adjustment from a major player has sent ripples of curiosity through the industry. While TSMC, the undisputed leader, continues to command premium prices for its most advanced nodes, a notable intraday price fluctuation has emerged, prompting questions about the underlying market dynamics and strategic positioning. This unusual price movement, though specific in its occurrence, signals a potential undercurrent of activity that warrants closer examination. In the foundry business, Pricing is a delicate balance of capacity utilization, technological advancement, and client relationships. Typically, as demand outstrips supply, especially for cutting-edge processes like TSMC's 3nm and upcoming 2nm nodes, prices tend to firm up or increase. The recent surge in foundry revenue, driven by AI, smartphones, and PCs, reinforces this trend, with TSMC's market share climbing to over 70%. However, market dynamics are rarely static. Several factors could contribute to such an intraday price shift. It might reflect a strategic move to secure a particular client's order amidst intense competition, a response to fluctuations in raw material costs, or even a signal about future capacity adjustments. It could also be a tactic to manage inventory levels or to preemptively address potential shifts in demand from key sectors. For instance, if a significant client renegotiated terms, or if there were a temporary oversupply in a specific node due to a client's production schedule change, it could lead to such adjustments. Alternatively, it might be a highly localized event within the broader market trend, perhaps related to specific packaging services or a particular tier of manufacturing node. The semiconductor industry is incredibly complex, with intricate supply chains and long-term contracts that can sometimes lead to short-term price volatility. Analysts are closely watching these movements to gauge their broader implications. Does this signal a potential softening in demand for certain applications, or is it a tactical play by a major foundry? The ability of foundries to command higher prices is directly linked to their technological leadership and capacity. Any deviation from this trend, even an intraday one, can be interpreted in multiple ways. It could be an attempt to capture market share from competitors, especially as players like Samsung work to close the gap with TSMC. Understanding the why behind such price drops is crucial for stakeholders, from chip designers to end product manufacturers. It affects cost structures, product pricing, and overall market competitiveness. As the industry continues its rapid evolution, driven by AI and other emerging technologies, such pricing anomalies, while perhaps minor in the grand scheme, offer valuable insights into the intricate workings and competitive strategies at play. These market maneuvers are fascinating, but they also highlight a larger trend we need to discuss. Let's talk about the overwhelming market share that's reshaping the entire industry landscape. Market share consolidation. The global semiconductor foundry industry is increasingly defined by a singular dominant force, as Taiwan's Semiconductor Manufacturing Company, TSMC, has further cemented its unparalleled position by capturing a record 70.2% of the market share in the second quarter of 2025. This represents a significant increase from its 67.6% share in the previous quarter, underscoring its relentless growth and strategic advantage in an industry critical to global technological advancement. The overall foundry market experienced a robust 14.6% quarter-on-quarter revenue growth, a surge attributed to a confluence of factors. Government subsidy policies across various nations are encouraging domestic chip production, while a proactive inventory buildup by companies in the smartphone, AI, PC, and server sectors has created substantial demand. TSMC has been the primary beneficiary of these trends, with its quarterly revenue jumping by an impressive 18.5% to reach $30.239 billion. This performance significantly eclipses its closest competitor, Samsung, whose foundry revenue stood at $3.159 billion during the same period. TSMC's market share expansion is a direct result of its sustained investment and technological leadership, particularly in advanced process nodes. The company is on track to commence volume production of its 2nm process in the fourth quarter of 2025, with initial capacity already secured by major clients like Apple. Subsequent orders from industry heavyweights such as Qualcomm, MediaTek, and Broadcom are expected to further bolster TSMC's revenue growth. Looking ahead, analysts predict that TSMC's market share could climb even higher, potentially reaching 75% by 2026, as demand for its cutting-edge technologies continues to accelerate. Adding to its dominance, TSMC is aggressively pursuing future manufacturing capabilities, including the construction of a 1.4 nm chip factory in Taiwan. This project involves an initial investment as high as $49 billion, signaling its unwavering commitment to maintaining its technological edge and anticipating future market needs. While Samsung is actively developing its 2nm gate-all-around (GAA) technology in an effort to narrow the gap, its current capacity limitations and customer base make it challenging to compete with TSMC's established ecosystem and advanced node leadership. Consequently, TSMC is expected to maintain its leading position in the global foundry market for the foreseeable future. In contrast, Samsung's market share saw a slight decline from 7.7% to 7.3%, with its revenue growth rate at 9.2%. This widening revenue gap highlights TSMC's absolute advantage in advanced processes and its superior capacity allocation strategies. The industry's reliance on TSMC is so profound that its performance often dictates the overall health and trajectory of the semiconductor market. The sheer concentration of manufacturing power in one company raises questions about supply chain resilience and competitive dynamics, even as TSMC continues to invest heavily in expanding its global footprint. This dominance is a massive story, but it's just one piece of the puzzle. Stay tuned as we wrap up with a quick recap of all today's top stories. And that's a wrap on today's essential updates. We saw TSMC shatter foundry revenue records, securing a dominant 70.2% market share. We explored how TSMC is balancing its record earnings with massive strategic expansion and its dividend strategy. We analyzed an unusual price drop that sent ripples through the market, and we unpacked the staggering market share figures that show TSMC's overwhelming industry control. Don't miss out on the next wave of innovation. Make sure to like this video, subscribe to Qualcomm Pulse for more cutting-edge insights, hit that notification bell so you're always the first to know, drop a comment with your thoughts, and follow us on all social platforms to stay connected.